Best options. Strategies under $500, 2026. Guide for small accounts. What if I told you that you do not need thousands of dollars to start trading options? In fact, some of the most popular options strategies can be started with less than $500. Yet many beginners never get started because they think options trading is only for people with huge portfolios. That is simply not true. Today, I am going to show you the best options strategies under $500 that can help you learn the market, manage risk, and potentially grow a small account without risking your entire savings. We will cover beginner-friendly strategies, common mistakes to avoid, and how to choose the right approach based on your budget. And make sure you stay until the end, because I will reveal the strategy that many experienced traders recommend for small accounts, but beginners often overlook. Let us get started. Why options trading is perfect for small accounts. One of the biggest advantages of options trading is leverage. Instead of buying 100 shares of a stock for thousands of dollars, an options contract allows you to control those shares for a fraction of the cost. For example, imagine a stock trading at $100 per share. If buying 100 shares would cost $10,000, but an options contract controlling those same 100 shares might cost only $200 to $500, depending on expiration dates and market conditions. That is why options trading small account strategies have become so popular among younger investors and beginners. However, leverage works both ways. A small investment can grow quickly, but it can also lose value quickly. That is why choosing the right strategy matters. Strategy 1. Long calls. Let us start with the most straightforward strategy, buying a call option. A call option gives you the right to buy a stock at a predetermined price before expiration. This strategy is ideal when you believe a stock will rise significantly over a short period. Imagine a company trading at $50. You believe strong earnings are coming next month. Instead of purchasing 100 shares for $5,000, you buy a call option for $200. If the stock rises sharply, your call option may increase substantially in value. The advantages are simple. Limited risk, high upside potential, easy for beginners to understand. The downside? Time decay. Every day that passes can reduce the option's value. 6. It might move as expected. For small accounts, consider looking for quality companies and purchasing slightly out-of-the-money calls with 30 to 60 days until expiration. This keeps costs lower while still giving the trade time to work. Typical cost: $100 to $500 per trade. Strategy 2. Long puts. Now let us flip the script. What if you think a stock will fall? That is where long puts come in. A put option gives you the right to sell a stock at a specified price. Many beginners focus only on bullish opportunities, but markets do not always move up. Sometimes the best opportunities happen during declines. Suppose a stock is showing weakness after disappointing earnings. Instead of short-selling shares, you can buy a put option. If the stock falls, the put option may increase in value. Benefits include limited risk, profit potential during market declines, no need to borrow shares. For traders with less than $500, long puts can provide a simple way to benefit from bearish market moves without exposing themselves to unlimited risk. Typical cost: $100 to $500. If you are learning options trading and finding this guide helpful, hit the like button and subscribe to the channel. Every week, we break down beginner-friendly trading strategies, risk management techniques, and practical investing tips that anyone can understand. And let me know in the comments, what is your current trading account size? Are you starting with under $500, under $1,000, or more? Now let us continue. Strategy 3. Debit spreads. This is where things get interesting. Many professional traders prefer debit spreads over simply buying calls or puts. Why? Because they reduce costs. A debit spread involves buying one option and selling another option at a different strike price. Let us say you want to buy a call option that costs $400. That is a large portion of a $500 account. Instead, you buy that call and sell a higher strike call. The premium collected from the sold option helps reduce your overall cost. Now the trade might only cost $150 or $200. Benefits: lower capital requirements, reduced risk, less impact from time decay. The trade-off is capped profits. You will not make as much money if the stock makes a massive move. But for budget options strategies, this is often a worthwhile compromise. Many successful small account traders use debit spreads because they allow better diversification and risk control. Typical cost: $50 to $300. Strategy 4. Cash secured. Puts on lower-priced stocks. This strategy requires a bit more capital, but deserves mention. A cash-secured put involves selling a put while setting aside enough cash to purchase the stock if assigned. Normally, this strategy requires significant capital. However, some lower-priced stocks trade below $5 or $10 per share. In these cases, the required cash can be less than $500. The goal is simple: you collect premium while potentially acquiring a stock at a lower price. Many long-term investors use this strategy to generate income while waiting to buy shares. Benefits: generates income, can acquire stock at discounted prices, high probability setups. The key is selecting quality companies and avoiding speculative stocks solely because they are cheap. Remember, cheap stocks are not always bargains. Sometimes they are cheap for a reason. Strategy 5. The poor man's covered call. Despite the funny name, this is one of the most powerful strategies for small accounts. Traditional covered calls require owning 100 shares of stock. That can cost thousands of dollars. The poor man's covered call replaces stock ownership with a long-term call option. You buy a deep-in-the-money LEAP call and then sell shorter-term calls against it. This dramatically reduces capital requirements. Instead of spending several $1,000s on shares, you might only need a few $100s. Advantages: lower capital requirements, income generation, reduced cost versus owning stock. This strategy takes more education and management than buying simple calls, but many experienced traders consider it one of the best options under $500 when executed properly. Strategy 6. Long straddles for big events. Sometimes, you know a stock will move, you just do not know which direction. Earnings reports are a perfect example. A long straddle involves buying both a call and a put simultaneously. If the stock makes a large move in either direction, one side may gain enough value to offset losses on the other. The challenge is cost. Many straddles are expensive. However, on lower-priced stocks, some opportunities can still fit within a $500 budget. This strategy is not ideal for complete beginners, but it is worth understanding because it teaches an important lesson. Sometimes direction matters less than volatility. Common mistakes small account traders make. Now let us discuss what destroys most small accounts. Mistake number 1. Going all in on one trade. If you have a $500 account and risk all $500 on one option, you are essentially gambling. Professional traders focus on risk management first. Mistake number 2. Buying extremely short-dated options. Many beginners love weekly options because they are cheap, but they also experience rapid time decay. An option can lose value quickly even when you are right about the stock's direction. Mistake number 3. Chasing social media hype. A stock trending online is not automatically a good trade. Always have a plan before entering any position. Mistake number 4. Ignoring position sizing. Even a great strategy can fail if the position is too large. Protecting capital should always come before chasing profits. How to build a $500 options trading plan. If I were starting over today with exactly $500, here's how I would approach it. First, I would never risk the entire account on one trade. Second, I would focus on liquid stocks with tight bid-ask spreads. Third, I would avoid highly speculative meme stocks. Fourth, I would prioritize learning over profits. For example, allocate only $100 to $150 per trade. Keep cash available for future opportunities. Track every trade in a journal. Review mistakes regularly. Remember, the goal is not turning $500 into $50,000 overnight. The goal is developing skills that can be applied as your account grows. Consistency beats lucky wins. Every time. The best strategy for most beginners. So which strategy is best? For most new traders with under $500, debit spreads are often the sweet spot. Why? Because they balance three important factors. Lower cost, defined risk, reasonable profit potential. Long calls can generate huge returns, but they can also lose value quickly. Debit spreads help reduce that risk while keeping capital requirements low. That is why many experienced traders recommend them for smaller accounts. That does not mean they are perfect. No strategy is, but they provide a practical combination of affordability and risk control. Conclusion. You do not need a massive account to start learning options trading. With the right education, discipline, and risk management, it is possible to begin with less than $500 and gain valuable experience. The key is focusing on strategies that match your account size. Long calls, long puts, debit spreads, cash-secured puts on lower-priced stocks, poor man's covered calls, and carefully selected straddles can all be useful tools when used correctly. Remember, small accounts grow through consistency, not reckless bets. Protect your capital, manage risk, keep learning, and let time work in your favor. If you enjoyed this video and want more content about options trading, small account strategies, options under $500, and budget options strategies, make sure to subscribe and turn on notifications so you do not miss future uploads. And before you go, check out the next video on the screen, where I break down the biggest options trading mistakes beginners make and how to avoid them. Thanks for watching, and I will see you in the next one.